Imagine you're in your late 20s or early 30s. You've been working hard. Maybe you've paid off some student loans, or you're just starting to build up a decent savings account. You look at your bank balance and there it is, a respectable chunk of change. Maybe it's $5,000, $10,000, $20,000, and it's just sitting there. Earning what? A measly 0.5%, maybe 0.7% if you're lucky. You know you should be investing, but the stock market feels like a casino. One day it's up, the next it's down 500 points. All your friends are talking about crypto or meme stocks. And honestly, it just feels like too much risk, too much stress. You want to grow your money, but you also want to sleep at night. You're not looking for a get-rich-quick scheme. You're looking for stability, for growth that feels solid. If that sounds like you, if you've got money sitting idle, feeling like it's not working hard enough, but you're wary of the wild swings of the market, then you're in the right place. Because here's the thing, you might be ready for something far more powerful and less stressful than you think. My name is Jordan, and I'm here to help you understand money, invest with clarity, and build wealth long-term with discipline. If that makes sense to you, subscribe to the channel now. Let's talk about that money sitting in your savings account. You've done the smart thing. You've built an emergency fund. That's fantastic. Most people don't even get that far. But here's what most people don't realize. An emergency fund isn't just about having cash. It's about having accessible, stable cash that retains its value. And right now, with inflation hovering, that money in a traditional savings account is actually losing purchasing power every single day. It's like having a leaky bucket. You keep pouring water in, but it's slowly draining out. Think about it. If your bank is paying you 0.5% interest, and inflation is, let's say, 3%, which is a conservative estimate for long-term averages, and often higher in reality, your money is effectively shrinking by 0.5% each year. That $10,000 emergency fund, it's losing $250 in purchasing power annually. That's not just theoretical. That's real money you could have used for something else. This is where fixed income bonds come into play, and specifically, certain types of fixed income that are perfect for this exact scenario. You see, many people in their 20s and 30s hear bonds and immediately think boring, low returns. For retirees, and for a long time, that was somewhat true. But the financial landscape has shifted dramatically today. We're seeing U.S. Treasury yields like the 10-year Treasury hovering around for 0.15% to 0.19%. That's a significant difference from 0.5%. And for your emergency fund, or at least a portion of it, you're not looking for the 10-year. You're looking for something even more accessible and inflation-protected. Enter I-bonds. These are U.S. Treasury inflation-protected savings bonds. They offer a combined interest rate that adjusts with inflation, while their fixed-rate component can vary. Their inflation-adjusted rate has been incredibly attractive. For example, as of late 2024, early 2025, I-bonds were still offering rates around for 0.03%. Now, there are some rules, like you can't touch the money for a year. And if you withdraw before 5 years, you lose the last 3 months of interest. But for a portion of your emergency fund that you don't anticipate needing immediately, or for money you want to keep safe from inflation, this is a game changer. Let's do the math. That same $10,000, if it's earning for 0.03% in an I-bond, that's for $103 in interest in a year, compared to $50. That's an extra $353 working for you, not against you. And it's protected against inflation. This isn't about getting rich. It's about preserving your wealth and making your safety net actually grow, not shrink. So, if your emergency fund is just sitting there, losing value, that's your first big sign you're ready for fixed income. Now, let's move to the second sign. You're either completely overwhelmed by the stock market's ups and downs, or you're doing the opposite. You're chasing every hot stock tip, every crypto surge, every next big thing because you feel like you're missing out. This is classic behavioral economics at play. It's FOMO, fear of missing out, driving your decisions, or it's loss aversion making you freeze up entirely. Look, the stock market is essential for long-term wealth building. I'm not saying avoid it, but a portfolio built entirely on high-growth stocks, especially when you're in your 20s and 30s and still figuring things out, can be a roller coaster. One day you feel like a genius, the next you're checking your portfolio every 5 minutes. Heart pounding. That's not investing. That's gambling with extra steps. Here's what most people don't realize. Fixed income isn't just about safety. It's about stability and diversification. It acts as a ballast for your portfolio. Imagine your investment portfolio is a ship. Stocks are the sails propelling you forward, sometimes at incredible speeds, but without a keel. Without ballast, that ship can capsize in a storm. Fixed income is that keel. It keeps your ship upright when the winds get rough. When the stock market takes a dive, often, fixed income assets either hold steady or even increase in value, providing a cushion. This psychological comfort is invaluable. It means you're less likely to panic sell your stocks at the bottom, which is one of the biggest wealth destroyers for individual investors. A study by Dalbar, a financial research firm, consistently shows that the average investor significantly underperforms the market. Why? Because they buy high and sell low, driven by emotion. They get excited when the market is soaring and pile in, then get scared when it crashes and pull their money up. Fixed income can help break this cycle. By having a stable portion of your portfolio, you reduce the overall volatility, making it easier to stick to your long-term plan. Now, you might be thinking, but Jordan, I'm young. I should be 100% in stocks. That's what all the gurus say. And yes, a higher allocation to stocks is generally appropriate for younger investors due to a longer time horizon. But 100%, that's a strategy for someone with an iron stomach and zero short-term financial needs. For the rest of us, a balanced approach is key. Even a small allocation, say 10 to 20% in fixed income, can dramatically smooth out the ride. Consider this: if you have $50,000 invested and it's all in stocks, a 20% market correction means you're down $10,000. That's a gut punch. If you had $40,000 in stocks and $10,000 in fixed income earning 4%, and the stocks drop 20% while the fixed income holds steady, your stock portion is down $8,000. But your fixed income is still $10,000 plus interest. Your overall loss is $8,000, not $10,000. It might not sound like much, but that $2,000 difference can be the difference between panic and calm. It's about managing risk, not avoiding it entirely. If market volatility is giving you whiplash, or you're constantly chasing the next big thing, that's your second sign. All right, let's talk about goals. You're in your 20s or 30s, so you're probably thinking about things like a down payment on a house, maybe a new car, saving for a wedding, or even going back to school. These are significant financial milestones, and they often have a specific timeline, usually within the next 1 to 5 years. Here's the problem: the stock market is fantastic for long-term growth, meaning 10 years or more. But over shorter periods, it's unpredictable. You could invest your down payment money in stocks today, and in 3 years, when you're ready to buy, the market could be down 30%. Suddenly, your dream house is out of reach, or you have to delay your plan significantly. That's a huge risk to take with money you absolutely need by a certain date. This is where fixed income truly shines for younger investors. For these short to medium-term goals, capital preservation and predictable returns are paramount. You need to know that the money will be there, and ideally, it will have grown a little. Let's look at some options. Besides I-bonds, which we discussed for inflation protection, there are also E-bonds. These are another type of U.S. Treasury savings bond. They have a fixed interest rate, and if you hold them for 20 years, they guarantee to double in value. But the current rate, around 0.50%, might not be as attractive for shorter-term goals compared to other options. However, they are incredibly safe. For those 1 to 5 year goals, you might consider short-term Treasury bills or notes, or even high-yield savings accounts and money market funds, though their rates have been declining. Money market funds, for instance, saw a massive influx of cash during periods of higher interest rates, reaching about $9.1 trillion globally. But as the Federal Reserve potentially starts to cut rates, those money market yields will likely fall. However, direct Treasury purchases, especially short-term T-bills which mature in a year or less, or T-notes to 10 years, offer a fixed return for a set period. You can buy them directly from treasurydirect.gov. If you need $50,000 for a down payment in 3 years, you could buy a 3-year Treasury note. You know exactly what interest rate you'll get, and you know that in 3 years, you'll get your principal back, plus interest. No market volatility, no sleepless nights. Let's say you invest $45,000 today in a 3-year Treasury note yielding for 0.15% in 3 years. You'll have approximately $50,800. That's a guaranteed growth of $5,800 without the risk of the stock market. Compare that to putting it in a savings account earning 0.5%, which would only give you about $675 in interest over 3 years. The difference is stark: $5,800 versus $675. That's an extra $5,125 towards your down payment. simply by choosing the right vehicle for your short-term money. This is where it gets really interesting. Many people think they have to choose between safe but no growth and risky but high growth. Fixed income for short-term goals offers a middle ground, safe and predictable growth. It's about aligning your investment vehicle with your financial timeline. If you have specific, important financial goals coming up in the next few years, and you can't afford to lose that principal, then that's your third sign. Finally, let's talk about the fourth sign. You're looking for a reliable income stream, or you want a way to rebalance your portfolio without having to sell off your growth assets. This might sound a bit more advanced, but it's incredibly relevant even for younger investors. As you build your wealth, you'll eventually reach a point where you have a substantial portfolio. Maybe you've got a good chunk in stocks, some in real estate, and now you're thinking, how can I make this money work for me in a more predictable way, without constantly selling shares? Or perhaps you've had a great run in the stock market, and your portfolio has become heavily weighted towards equities, making it riskier than you'd like. Here's what most people don't realize. Fixed income can provide a consistent, predictable income stream. When you own a bond, the issuer, like the U.S. government or corporation, pays you interest at regular intervals, usually semi-annually, until the bond matures, at which point they return your principal. This is a stark contrast to stocks, where dividends are not guaranteed and stock prices fluctuate wildly. Imagine you've accumulated a portfolio of $100,000. If you allocate $20,000 to a bond fund or individual bonds yielding, say, 4%, that's $800 a year in predictable income. This income can be reinvested, used to cover small expenses, or even used to buy more stocks when the market is down, effectively buying the dip without having to dip into your principal. This also ties into portfolio rebalancing. Let's say your target asset allocation is 80% stocks and 20% bonds. Over time, if the stock market performs well, your stock allocation might grow to 85% or 90%. To get back to your target, you typically sell some stocks and buy bonds. But what if you don't want to sell your winning stocks? Especially if you'd incur capital gains taxes. This is where new money comes in. Instead of selling stocks, you can direct new savings or the income generated from your existing fixed income holdings into bonds until your target allocation is restored. It's a smoother, less tax-intensive way to maintain your desired risk profile. Think of it like maintaining a balanced diet. You don't just eat dessert all the time. Even if it tastes good, you need your vegetables and proteins too. Stocks are the exciting, high-growth dessert, but bonds are the steady, nutritious main course that keeps your financial body healthy and stable. This strategy is particularly powerful for those who are starting to think about financial independence or early retirement. A diversified portfolio with a healthy fixed income component can provide the stability and predictable income needed to weather market downturns during your withdrawal phase. Even if you're years away from retirement, understanding how to generate income from your investments and how to strategically rebalance your portfolio is a powerful skill. If you're looking for ways to generate predictable income or to intelligently manage your portfolio's risk without constantly selling assets, that's your fourth sign. So, we've talked about your emergency fund, market volatility, short-term goals, and portfolio stability. These aren't just isolated financial decisions. They're deeply intertwined with our psychology. The human brain is wired for immediate gratification and to avoid pain. That's why we often leave money in low-yield accounts. It's easy, no decision needed. Or we chase speculative assets, the thrill of a quick win. Or we panic when the market drops, loss aversion. But investing with clarity and discipline means overriding these primal instincts. It means understanding that safe doesn't have to mean stagnant, and growth doesn't have to mean gambling. It means recognizing that fixed income, often dismissed by younger investors, is a powerful, versatile tool that can serve multiple purposes in your financial life. It's not just for your grandparents, it's for you right now to build a stronger, more resilient financial foundation. Here's what most people don't realize. Fixed income isn't just about playing defense. It's about smart defense. It's about having the liquidity and stability to seize opportunities when they arise. Whether that's buying a house, starting a business, or investing in a market downturn, it's about reducing stress so you can focus on your career, your family, and your life, knowing your money is working hard and safely for you. Alright, so you've identified with one or more of these signs. What do you do now? Here are some clear, practical steps you can take immediately. First, assess your emergency fund. How much do you have? How much do you need? For the portion you don't anticipate needing in the next 12 to 18 months, consider moving it into I-bonds. You can buy them directly from treasurydirect.gov, It's a straightforward process, and it's backed by the full faith and credit of the US government. Second, look at your short to medium-term goals. If you're saving for a down payment into 5 years, explore short-term Treasury notes. Again, treasurydirect.gov is your friend. You can buy them in various maturities to match your goal timeline. For slightly shorter horizons, or if you prefer more liquidity, compare high-yield savings accounts and money market funds. But be aware that their rates are variable and likely to decline if the Fed cuts rates. Third, evaluate your overall portfolio. If you're 100% in stocks and feeling the emotional roller coaster, consider adding a small allocation to a broad bond ETF or a diversified bond mutual fund. Start small, maybe 10 to 15% of your portfolio. This isn't about sacrificing growth, it's about enhancing stability and reducing risk. Fourth, educate yourself further. Don't just take my word for it. Read up on different types of bonds, corporate bonds, municipal bonds, agency bonds. Understand their risks and rewards. The more you know, the more confident you'll be in making these decisions. Remember, building wealth is a marathon, not a sprint. It requires discipline, patience, and a clear understanding of the tools at your disposal. Fixed income bonds are not the flashy, exciting investment that gets all the headlines, but they are the bedrock of a strong, resilient financial plan. They are the unsung heroes that provide stability, preserve capital, and offer predictable returns, allowing you to pursue your bigger financial dreams with confidence. Don't let common misconceptions or the fear of the unknown hold you back. You've worked hard for your money. Now, it's time to make your money work smarter and safer for you. If this video helped you understand how fixed income can fit into your financial life, please give it a thumbs up. It really helps the channel. And if you want more clear, actionable financial advice to build long-term wealth, make sure you're subscribed and hit that notification bell so you don't miss future videos. What are your thoughts on fixed income? Are you already investing in bonds? Let me know in the comments below. I love hearing from you. Thanks for watching, and I'll see you in the next one.